Joining me now is Michael Darda, chief economist and market strategist at MKM Partners. Mike, welcome back.
Thanks for having me, Kelly.
I was afraid I'd gotten kicked off your list, or maybe I mean, I don't think I've gotten anything from you in a month.
Oh, really? Well, our firm was just bought by Roth Capital Partners, so it could have been an email issue. But yeah, we're not ghosting you. I promise you that.
All the February data's coming in. I'm like, is he changing his mind? Like, what's going on here? And I was being blacked out. So have you, I mean, in light of the strong January data, Mike, what would you say about the idea that we still look, as in terms of the business cycle, to be heading into a recession? But there are those out there pounding the table and saying, no, the consumer's going to keep going strong here.
Yeah, it's a little surprising. I mean, we were getting a lot of weak data coming into the end of last year. January has featured surprising data to the upside, and it seems like the consensus forecasters went from a worry about imminent recession to now straight line forecasting above trend growth. And now you have people talking about no landings or soft landings. But our view is that you have to take into consideration the Fed's reaction function. The Fed does not have your back here. The Fed wants below trend growth. It wants tighter financial conditions, and it wants weakness in lagging indicators of price level pressures like the services CPI, for example. And so if you get strong data, that just reinforces a more hawkish Fed, and they'll just tighten as much as they have to get the desired result. And below trend growth with a rising unemployment rate goes by another name, and it's called recession. So I don't think the January data really changes the outlook. We know, obviously, the economy looked pretty strong in January, but, let's not take 1 month's worth of data in straight line forecast into the future. That just doesn't, to me, that just doesn't seem to be very wise. Let's see where we are this summer and fall. That's really a danger zone for the economy. And if the Fed funds rate is up at, 5.25, 5.5, right as things really start to weaken, the landing could be much harder than what people have been talking about.
One more. I want to talk China and Europe before I let you go. But on this point, and we know what they're probably going to do, but if you were in charge of setting the Fed funds rate right now, would you be lowering it?
Well, that would cause a lot of confusion just simply because, the Fed has put its parameters out there. We may disagree with their framework, but the framework is a slack-based Phillips curve model. The focus is on backward-looking indicators and, some degree of data dependency, and the data that they're dependent on just got better. So if they shifted to cutting rates now, it would create a tremendous amount of confusion. What I would try to do is focus the Fed more on forward-looking information and more on preemptive strikes. And so you don't end up way behind the curve, blowing through your inflation target and then having to catch up. It's virtually impossible to soft land in a scenario like that. And I think that's the predicament for the future.
Okay. And kind of following from this, obviously, you're not hugely bullish on equities, although healthcare maybe is one area that you think can do okay here.